Greetings, this is Eric Falkenstein. I'm going over 10 IL minimizing mechanisms. So let me start. We have, first, I'm going to assume some familiarity with AMMs and LPs, and you know these acronyms and these terms, automated market makers, liquidity providers. There's another place to go to for the intro stuff. I don't want to take up too much time with that. It's long enough. So the problem is that the LPs lose money. And what do I mean by that? It's, well, they make fees. So that's easy to do. You can count the fees, count the volume traded, multiply it by the fee rate, and you get their revenue. Great. And usually that's what's all that's represented in the APYs that AMM's protocols present, just the revenue. But the cost, because it can't be free, right? Otherwise, it'd be a money pump. So what's the cost? The cost is this impermanent loss. And on average, the impermanent loss is greater than the fees for capital efficient AMMs. Now, for the non-capital ones, like the old Uniswap V2 one, they make good money, but unfortunately, they're not very popular as they're not capital efficient. They make 5-8%, but they're small. So they're not attractive. If we want capital efficient pools, those pools don't work. And so IL is, this is a standard HODL versus LP, and the difference is IL. And if you look at this loss, this IL is a function of the V2 LP value, you see it looks a lot like the absolute value of the price change squared. And this loss being a function of the square comes up later. But this is what it looks like. And it can be zero, right? It can always come back. But we have the expected value of this, so we know it is. It's a positive number. And, you can use a moment generating function to get the exact expected value of this thing. And I have months here on the bottom going from 0 to 90, so it goes way out. And you can see it's nonlinear. But for reasonable horizons, it's linear. That is 12 months or less. We know what it is, so it's not like there's any asymmetric information here. The LPs and the ARBs and everybody else knows the expected drag on this because of the IL. So that's a problem we have to overcome, and let's go to the next one. First I want to mention, I'm going to use the word or phrase impermanent loss or IL. If you want to be pedantic about it, IL refers to a particular return for an arbitrary, some specified start and end date, starting and ending price. When I mean IL, I mean the expected IL, average IL, like on average, because you can get lucky. It can be impermanent and it can be zero, but on average, it is what it is, and you can't hedge it away. You can minimize the variance of this loss, but you can't affect its expected value. Which is going to be the average. And if you hedge it, you'll have your realization will be closer and closer to the average. But anyway, it's called in the literature, from the options literature, because this really derives from the options literature, which has been around for 50 years since Black-Scholes. It's called gamma decay or convexity costs or theta. So there's a big literature on that. If you Google any of those terms, lots of good academic papers on that, understanding it. It is a very subtle concept, and I'd say this is one of the hardest financial concepts for people to grok. But anyway, this is the cost, the main cost, and this is why most protocols don't even list this cost. So, in terms of the AMMs, this is known as loss versus rebalancing or lever by many people. It also can be framed as the hedged LP P&L without fees. That's capturing the same thing. And, what you name it is often like how you derive it. You can derive it actually 6 different ways. I mean, the fun thing about concept product AMMs is the mathematics is so cool because, like the Pythagorean theorem, you can prove 17 different ways or something. You can prove all these results several different ways. But nonetheless, it's an expected cost. When I say IL, and the name's not important, just so you know what I'm talking about. But let's go on to some of these bad ideas. There are many takes on how to eliminate this. So you see every month or quarter, somebody's got a new protocol that eliminates or massively reduces IL. Some people mistakenly think that hedging the IL gets rid of it. It doesn't. It just kind of turns it into a certainty. And so I have one coming out next week. I can tell you about. And I don't have time to go over all of them just because there's so many, and most are just patently bad. So let me just start with the patently bad solutions. This one came out last week by the head of Curve, Michael Egorov, and this was interesting because this was just a math error. It's kind of funny. He does this little trick where it's kind of like when you prove that 1 equals 0 using algebra, and you make a little mistake where you basically you divide by 0 and it's not obvious. Well, he takes the derivative of something he treats as a constant when actually it's a function of one of the other variables. But it took me an hour to really dig through his math to figure out where it was. And, he has enough money that I'm sure he paid a mathematician to look at it. The trick is the parochial, terms and variables are so, that's beyond math. You have to know, what does this variable really mean? And most people just don't. The math people don't want to learn about what the variables are, and the people who understand the variables don't like to do this sort of math. But you can tell he's wrong because at one point at the end he says, "Well, I can make this portfolio that's proportional to the LP position squared." And then elsewhere in his proof, he had the value of his portfolio or the value of his levered LP position equals the notional value of the LP position divided by 2. So that's a contradiction. But anyway, you can look at my Substack post to go into the math. The bottom line is this was just a simple math error. And it was so convoluted, not a single person other than myself really dug into it and highlighted the crux of why it fails. And that's usually the case. When people are wrong on these things, everyone just walks away and says, well, not my problem. But another bad solution is IL protection or insurance. And this came from, I think, the intuition that it truly is impermanent loss. So if it's truly impermanent, the only people who lose from this are people who are impatient. If you wait long enough, prices revert. And we see, for many of the big coins, they have had double, peaks. They had a peak in 2018, a peak in 2021, or, more recently, Rune peaked in 2021, and then it also, got pretty close to it in 2023 or so. And then, Solana, I think, they had a peak in 2021 and recently, beginning of this year. So if you think that that's just a pattern, that crypto is destined to be mean reverting and always come back, then yeah, you can offer insurance on this because it's kind of costless. But that's just a mistake. If asset prices were truly mean reverting, that'd be a huge arbitrage opportunity. It's kind of delusional to think that. Both Bancor and Thorchain offered this, and they both had to discontinue it. Bancor actually defaulted. Thorchain, well, they did this before one of their more recent disasters, but they were about to default. That's why they had to stop, and then it went the other way. But anyway, that's a bad solution. It was tried because people really believed these things were an impermanent loss, and they're not. There's MEV tricks, which get a lot of press because they're pretty devious, and so it's interesting to look into them. And there's different categories of MEV. One is the sandwich attacks, or just one leg of it would be front running and the other leg would be back running. And this just hurts the retail trader. So the retail trader wants to make a trade, and usually he's making a big trade, and so if he makes a big trade, he's going to move the price up 1%. What you can do is put a smaller trade in front of it. Pay to put your trade in front, and then he'll push your trade up, and then you sell out, and by the end of the block, you're flat, and you made a little money off of this guy. So that's not nice. If you can come up with mechanisms to eliminate that, that's good for your traders. It'll get more trust in your AMM, but it has nothing to do with impermanent loss because this all happens in a block. if you just look at this lever formula for impermanent loss, you'll see it's liquidity times price squared times volatility squared divided by 4. Where would these little block tricks fall? Nowhere, because the relevant horizon for passive LP is at least a day, probably a week at least, and any of those tricks just don't matter over those sorts of horizons. So sandwich attacks, yeah, they're bad. If you can get rid of them, great. It's nothing to do with impermanent loss. Next one is another MEV trick, which is just-in-time liquidity provision. And this is where just somebody, liquidity is say 100, and then you see someone making a big trade, and then what you do is you sell, or you create a little window of restricted range liquidity just above that or below that. So you capture it all, and you capture the fee, and you basically make making a passive trade to get in front of it. And these are they take money away from the good LPs that we will like, so that's not good for them. But it's just not economically significant, because even on the big V3 pools where this happens most frequently, so like the ETH-USDC pool, it's around 1% of the volume for them, and that's higher than average, I think. And since the average V3 LP, their cost, their IL, is on average about 116% of fees. If you added 1% to the fees, you wouldn't really materially change how much the V3 LPs are losing. And so, I show a little graph here of the these trades, and you can see 150 trades that happened on this day, and it seems like it's a lot, but they trade a lot on this pool, and it's just not a lot. And obviously the JIT trade is actually great for the retail traders, so it's not hurting them, and you're hurting the LPs, but not by enough to really make this a first order consideration for getting rid of the problem, which is on average for V3 they lose 16 cents for every dollar they make in fees. Another patently bad idea is single-sided liquidity, and this comes up again and again. I think it was behind the recent fluid problem that happened a month or two ago. And what they do is they say, listen, when you put in 2 tokens, you get this IL problem. And so just put in 1 token, we'll treat it like a bond. And so you put in 1 Bitcoin, you'll get 1 Bitcoin back plus interest. Well, the weird thing about this is it's really just a convoluted mechanism for leveraging LPs, because you could just give the LPs leverage and get the same result and not take in the outside. I mean, the money they give you, if you have to pay it back, it's not helping your liquidity at all. And so all you're doing is leveraging the LPs. And if you really want to do that, you can just leverage them. I have here in the little graph, the baseline is this black line. That's the base standard LP position. And, if you have this red line here, then what happens here is, well, someone added single-sided liquidity of BTC equal to the current value. So they doubled the liquidity by adding single-sided liquidity of BTC. So what did this do? It created a negative delta. So what that means is after a certain price rise, the LPs are going to be bankrupt. So you're going to need a liquidation mechanism anyway. So just give them leverage directly. The most important point is it doesn't change your gamma. So the residual LPs who are actively, actually supplying liquidity, their gamma is increased. So great, it's kind of like restricted range. You can increase your gamma that way. I mean, restricted range V3 LPs are getting more gamma, but it's not. It comes with a cost, which expected IL is linear in gamma. So yeah, this is a nothing burger. It just confuses people and then causes people to be shocked when they find out they lose a lot of money. The residual liquidity is often called protocol owned liquidity, or POL, and that's just toxic liquidity, because that the owners of this protocol are just going to move stuff around, and they probably do this because they don't really understand gamma. and then they're going to be shocked when the price moves a lot and all their LPs complain because they didn't realize how much money they were losing. And okay, so as to plausible solutions, this is a set of bullet points from Mimak Moalemi of Columbia. And there are a lot of academics at Columbia, and some of those guys have ties to A16Z, so they have a lot they've written on this stuff. They're kind of like, I'd say, the academic consensus on AMMs and stuff. Mimak Moalemi actually is one of my better favored expositors of AMMs. I think he's a very good presenter, although I think he's profoundly wrong about a lot of things. But, he's good at explaining just basics of AMMs, so good for him. And he says, he's one of the lever guys, and he says, some of the solutions include faster blockchains, dynamic fees, oracles, and whitelisted authorized ARBs. And so those are in some of these solutions here. So we agree on that point. And so let's start with oracles. Some AMMs have oracles. I think Drift and Bancor have these multi-token pools, so they have, and they use the oracles to update the coefficients on the tokens in these multi-token pools. DYDX is a perp. All the perps use oracles for their funding rate, but DYDX, I think, uses oracles actually to price the pools, which, they can because they're centralized. They do the pricing off chain, so, but that gets into one of my big beefs with oracles is they're centralized. And another application of oracles is people have proposed asymmetric fees. So, if the current price of, the asset on your AMM is 100 and it's 101 on Binance, you know that the AMM price is going to go up to 101. So you charge, the ARB 1 unit to put the price back up to 1 or something. So I haven't seen that actually implemented, but for some reason people like that. But I think that's not going to work for several reasons. One is because the 5 and 30 basis point pools both lose about the same amount of money. So asymmetric fees is kind of like that. And the other is, oracles, not a fan, because to the extent you can align the incentives. So you can say, okay, the cost of cheating me is an AMM, where you might be able to, make, $1 million cheating this AMM. Well, then you have to be able to penalize the Oracle by $1 million. So at every point in time, the cost benefit analysis points them to wanting to report the truth. But for them to have that much value, they've got to be a big corporation like Chainlink. And Chainlink has executives in highly regulated countries like the US. And at some point in time, the Dodd-Frank gives them the authority to go in and tell them to turn off access to various pools. And I'm sure that U.S. regulators, if ever a pool gets big enough and relies on Chainlink, they can and will censor them. So it's not a long-term solution. And if they're not big enough to be intimidated by the feds, well, it's really hard to design an incentive mechanism so that the decentralized oracle, the cost of cheating, you can inflict that upon them, because decentralized oracle is not going to post up a bond of $10 million that's sitting there every time they post a price, and then you'd have to have a mechanism for enforcing that, and finding out did they really cheat, and because we're talking about 50 basis points, it's not going to be huge. So it would be a mess. I have no incentive. These are fine for things that really don't matter about the long run, good for little games. But long-term solution, we want a mechanism to trade large amounts in a liquid pool on the blockchain, decentralized way, and oracles are not, I think, part of that solution. For the rest of these solutions, they all rely on this perfect competition assumption, and it works like this. In perfectly, if you have perfectly competitive AMM arbitrageurs, and you can get them to compete with each other so that they make a net profit of 0. Now, the gross profits will always be equal to the IL. That is, the gross profits for ARBs were just price setting with, say, Binance. The gross profit, so there's a profit before fees, will always be the IL. And if you do simulations, you can actually see this. I did this in a computer program, and this popped up before I even knew that this was true. By definition, the other traders, the non-ARB traders, we call noise traders. And not because they're noisy in the head, but because white noise is mean zero. And so noise traders have, by definition, mean zero net demand. So that means when the price moves a lot, the net demand from noise is zero. So we can just focus on the ARB traders. And if you just focus on them, you see that they mirror the LP's changes. So if the price moves way down, the pool gets, say, 50 ETH. Well, the ARB sells. He becomes short 50 ETH. And then if you look at the net, amount of USDC he gets and get his profit, well, it's exactly mirrored by the ARB's profit. So the LP loses 9,000, the ARB makes 9,000. And that's the way it works. So, but that's really the gross profit. We don't have any fees in these little tables here. So the hope is if you have the ARB pay the fee exactly equal to his profit he makes from ARBing the pool, well then guess what? Then the LP basically he's flat on his IL position because he's going to make in fees what the ARB makes in IL, and so that's the essence of the solution for a lot of these things. So let's look at the next one. So if we see the so let's look at dynamic fees. In general, AMM fees are for risky tokens are fixed at 5 or 30 basis points. Well, we know that the LP's expense, this cost, this nebulous gamma cost, is proportional to the variance. That is, the expected IL is linear in the variance of the asset returns. And so why not have a fee that's proportional to the variance? And so, you have these models to predict volatility, and volatility is autocorrelated. So they have these autoregressive conditional heteroscedasticity models, GARCH, ARCH. You can predict these. You're still going to have a very noisy R squared, but you can predict them. So you can predict the volatility, and as volatility goes up, then you can raise the fee, and hopefully, that would make things better. Because if you fix it at, say, 15 basis points, well, you might say, well, it should be 15 basis points on average, but that means half the time it's going to be too high, which means you're going to discourage the good noise traders you want. And half times it's going to be low, and the ARBs are going to be taking advantage of you. So it's the worst of all worlds. But if you try to do this in practice, it just doesn't work. If you look at what actually happens in Trader Joe, for example, where I have a lot of data, you see that they have two pools for AVAX USDC, and both lose money. The lower fee one loses more, it hasn't been around as long, but they both lose considerably more than they make in fees, or the costs are considerably more than they make in fees, so they lose money, and more so than the average V3 pool. So whatever Trader Joe's doing, which is their variable fee mechanism, that's not it's not helping. But another way to see this is to look at the identical pairs on identical blockchains, but with different fees. So you got 5 basis point version of the ETH USDC, and then you have a 30 basis point version, and both V3. And then same for BTC ETH. And what do you see? Both of them, they lose money in both cases. So one has 6 times the fee rate, and they both lose money. So it's not, if you were able to vary the fee over time, why do you think, this would actually cause you to actually make money? Traders, the ARBs shouldn't be treated exogenously. They're endogenous to the system. They react to the fees. And, for the outsider looking at the fee move around all day, it might seem like, oh, well, the fee changes and they're not going to react. In the same way that an ARB knows that this is a 5 basis point pool, so I'm going to trade up to 5 basis points. The ARB will know exactly what the cost is on the variable rate fee pool. It'll change over the day, but presumably it's going to be open source and everyone's going to know the algorithm and he's going to be watching it. And so as it moves around from 5 to 15 to 27, it's going to be adjusted, and so it's not going to make any difference at the end of the day, because we don't see any difference between 5 and 30 basis point pools on V3 pools with the same tokens, the same blockchain. So varying it is not going to change, because our reactions our behavior is endogenous. So another solution is this trade price equals end of trade price. And a couple of Thorchain and CowSwap have something, they have different names for it. But the whole idea here is, well, if you have, the arbitrage P&L is which is the inverse of the impermanent loss. So it's how much ETH you traded. Here I'm using an example of like ETH, USDC. I like to just use ETH as an example all the time. But anyway, it's the quantity that he trades times the amount he moves the price. And so it's ending price. Presumably this is a ending price here, P1. If you make, right now he makes a big profit because the fill price is the geometric mean of where the price started and where it ended. So they always make money when they move the price. But what if instead of making the fill price the average price of where he started and ended, make it the ending price? Well, that in case we have arbitrage P&L is going to be P1, ending price minus P1. So that's 0. Yay. So now the arb makes 0. And whether, in Thorchain, it's not really the ending price. They add a fee such that it's in effect the fill price is the gross fill price with the fee is exactly equal to the ending price. And I don't know exactly how CowSwap does it, but in effect, it's the same thing. And this is easy to get around. All you have to do is split up the trades, and you can get around this, because if the arb was to look at a price of 100 and say, oh, I want to push the price of 105, standard AMM, they pay a price of 102.5. So with this mechanism, they would charge that same arb on that same trade 105, but then the arb would outsmart him and say, oh, well, I'll make a bunch of little trades where I'll make one trade that pushes up to 101. So my cost in the first leg is going to be 101. And then the next one, I'll push it up to 102. The cost in the next leg is 102. And so in effect, if you do this in small enough groups, the average fill price that the arb pays is close to 102.5. And so it's totally negated. And, one of the arguments was, well, because of competition, they're not going to have, the arbs are going to want to pay 105 right away, and just so they can get the trade in. If you split it up, you might lose out. Well, yeah, but the arb who splits it up is going to make a profit. So we can afford to pay, the validators or sequencers to put them in the queue. And so he's going to make a profit, and he might end up losing that profit by having to pay the validator to get in front of everybody. But that just means that his fee that we wanted to go to the LP now just went to the validators, didn't go to the LPs. So this isn't going to be a good solution either. And if you look at Thorchain, I looked at 2 years of their data, even before they blew up in January of this year, and their AMM was losing 20 cents for every dollar they took in. You have to exclude their goofball rewards program and all the other bells and whistles. But the bottom line is they took in, for every dollar they took in fees, it cost them, 21 cents or $1.21 in IL. So it wasn't helping them. They were not fooling anybody. That does not work. And now auctions. There are a couple classes of auctions here. The first one I want to go over is these kind of like RFQ ones offered by Uniswap X and Gnosis and CowSwap, One is Fusion. And the whole auction literature, I think, is really highly influenced. Everyone references Bootish, Crampton, and Shim. I have a take on this if you want to read it, but that's a sidetrack, so I won't talk about it too much. I'm not a fan of that thread, but academics love this thread, and it's like the hottest thing for financial profs these days. But it's been around for over 12 years, and no exchange has implemented anything like it. And they have dark pools. They could easily put up a dark pool. If this were great, someone's dark pool would be exploding. But it's used as a gimmick in all the exchanges. I think even IEX, which is so loved by these people, has it just as a gimmick. It's not a, they've always had a couple of batch, occasional batches, but that's not the same thing. It's a minor adjustment in practice, but it has a thriving academic literature. So anyway, with an auction, the auctions here, the first class, are like RFQs. So they put these things up, and someone puts in a trade, and then they put it up for bid, and yeah, you'll get a good price on it. But then the people putting in their trades are just throwing it out there, and you're basically front running the LPs. And really this is just like payment for order flow, except the order flow is not going to the LPs, it's going to the upper level. I mean, God knows Uniswap, to the extent they make money, it goes to Uniswap Labs, not uni holders. It doesn't go to LPs either, So this isn't helping, it's helping some people, but it's not helping LPs. And further, these auctions are centralized. They have decentralized roadmaps, but so does every L2. And I don't think those are very credible promises. It's very hard to audit the security and the actual transaction efficiency, because if they're sending these trades in off chain, then how are you going to know the timestamp? I haven't seen any good data on that, but I just think that this is just like RFQs. You're front running your own LPs. If anything, you're going to make them worse. It might be a good thing. Might be good for the traders. Nothing wrong with that, but it's not a solution to IL. So now the other type of auction is this mechanism to get the auction proceeds directly to the LPs. And so the first line of research here focused on having people bid for particular blocks, or getting the right to be the first trader in a block. And there are a lot of problems with doing this in real time, coordination problems. You have a lead searcher, and there are gas issues there, so that's technically it's just a mess if you do this on a decentralized blockchain. Every block, a more fruitful line of research is this auction managed AMM proposed by Adams and some paradigm in Moalemi and 24, and they said, well, why don't we have an auction, say, ex ante on Sunday night? The ARBs bid to get monopoly rights over Monday, and they'd be allowed to set the fee, whatever they wanted, and they'd get all the fee revenue. So that means that they basically trade for free, because whatever fees they pay come back to them. And so if we think that the gross ARB profits that are available to them is the expected IL for the next day, so they'd have to forecast volatility, and then the expected noise trader fees, so some sort of estimate of the volume. And in perfect competition, they should pay exactly what the expected IL and noise trader fees are, in which case it'd be great. So then there would be no leakage. The winning bidder would pay for the expected IL at least, and then he'd also pay for the noise trader fees. I think Bunny AMM on V4 is doing this now, although in practice, I think I've seen that they do this happens like 20% of the blocks or times, periods. But so we don't have any, I haven't seen any data on how it's worked out. But my main reservations are, one, they're going to put in a risk premium. They're not going to bid the full thing, the risk neutral price. Okay, fine. But more problematic is if you're serial monopolists, already there's always a handful of ARBs tending to these pools. And so if you're going to have serial monopolists, you're going to probably, half of your ARBs are just going to say, well, I don't want to deal with that. And so now your set of ARBs is smaller. And, whatever games they're playing now, they're going to intensify those games. And I think that they'll be manipulated just like the ones are today. The last one here is this low latency idea. And this is This is interesting because it's built on this idea that the arb profit is linear in the square of the price discrepancy. So the difference, the arb profit, what I call the edge, that is between like the current price in AMM and the ending price for the arb, which is going to be the Binance price plus or minus the fee. That is going to be proportional to the square root of time in the block, and so whatever that is. And so if everyone's a perfect competitor, when the longer blocks just mean, bigger edge, bigger price opportunities. And so, if we shrink the block time, we should be able to shrink that edge. And that's going to mean that the arb fees are going to approach lever. Why? Because lever equals the gross arb profit, right? That's you can look at the math on that in the lever literature. In my SSR on paper, I go over that. You can also do a simulation and see that. But so it's just because this edge, this profit is basically the trade size times the price deviation, right? And what's the price deviation? Well, it's the edge divided by 2 because your fill price is in the middle between your initial and ending price. And what's the ETH amount traded? Well, it's also a linear function of edge divided by 2. So quantity times, profit, price profit, you've got edge over 2 in there squared. So the profit is a function of this price opportunity squared. So if you can get this arb net profit, and this is after fees, to go to 0, that means that the arb fees are basically approaching the IL, in theory. So that's how it should work. And then what do we see? Well, Arbitrum's been around for 2 years, and Base has been around for a while. And Base is at 2 seconds, Arbitrum at 0.25 seconds, compared to Ethereum's 12 seconds. And if you look at identical token pools on Uniswap in V3, same fees, you do see on Arbitrum for the ETH USDC pools slightly better in the Arbitrum, but not, they're still losing money, but it's a little less, but not a huge amount. In Base, it's actually slightly worse, but whatever. They're about the same, so it didn't really help going from 12 to 2 seconds. And then for the BTC ETH pool, in the 7 months we have overlapping data for these pools, Arbitrum actually does worse. So somehow the ARBs are not behaving as we would expect. And so we have to find out, well, what's the limiting principle here? Why aren't they, acting like perfect competitors and doing what we think they should? And so I think the takeaway is the ARBs can and will collude at some level. There will be some tacit collusion. We know that, if you play a repeated game, and arbing is a repeated game, you've got 6 players, whatever, and they're all arbing the same thing. And they don't want to be stuck in the prisoner's dilemma, where you're stuck in the bad equilibrium, where everyone loses. You want to get to the good equilibrium. And, tit for tat, Robert Axelrod's done work on this. If you play a repeated game, if you play nice, you can make money. If you play, uncooperatively, then everyone gets 0, and no one wants to play that game. So people figure it out because it's in their best interest to do so, and it's really hard to prevent that. And we see precedents for that in the real world. In TradFi, famously, Christie and Schultz found that NASDAQ market makers, NASDAQ dealers, they had a dealer system, and they had 60 dealers. Maybe it was only 5 or 10 that were big, that dominated. But anyway, more than the number of ARBs. And on a huge market, which is the NASDAQ stock market, which had billions of dollars, on the largest stocks like Microsoft, which was in the top 10 stocks at the time, their spread was twice that you'd see on the NYSE for comparable market cap. And just to highlight that it was purely it clearly was collusion. The second there was a press release on this paper, the market spread on that fell and by like 60% or something. the very next day and stayed there. So how are they able to maintain this? And there in TradFi, you obviously have legal costs, and you're not going to have those in the blockchain because everyone's pseudonymous. So if they can collude on Microsoft for 5 years with 60 dealers, we should expect collusion in the blockchain when you have 5 ARBs. Another data point is just that if you just look at the bid-ask spread on U.S. stocks over the past century up to 1990, it was 60 basis points the whole time. And there was a lot of technological progress over that time. Even before the internet, there was technological progress. And yet they were able to maintain that spread at that high level. And nobody was the wiser. I know guys who were specialists then, and they would make money every single year, every single day, except for like 1 or 2 days a year. That was common for specialists. It was a license to print money. And it wasn't written down anywhere. No one did exposés. There was no, specialist boys paper by the Michael Lewis of that time pointing out that this was going on. And then we got, high frequency trading and the internet, and it got rid of that. So it happens in real life. We should anticipate that. And so the solution, I think, is really based in transaction cost economics, work by Ronald Coase, Oliver Williamson, Douglas North, and the key there is markets shouldn't take them for granted. Don't assume that free entry and exit is sufficient. Property rights are essential here, and we see this in the third world all the time. When you don't have property rights, there's a lot of market failure because it's just hard to enforce contracts and all these messy things that we kind of take for granted. When you go away from the abstract idea of selling widgets. And so in the context of property rights for the AMMs, it's like, what are the ARB rights? On CLOBs, the market makers, designated market makers, they get special rights. They often get special leverage rights. They get, first in queue rights and stuff. And they get special rights, but they also have responsibilities. And so that's a quid pro quo. And you can't just open it up and say, okay, anybody can bid. And in practice, nobody does that. How do we do that? You have maker taker fees, you have things like that. So how do we minimize the ARB's transaction costs? Because if we minimize their costs, then we would have to pay them less, whatever mechanism we come up with. So that's another thing we want to focus on. To align their incentives, given we know there is a handful of them playing a repeated game, and they have an incentive to collude and maximize their profits because they're regular people. I'll talk about my solution, which has already been posted up on my Substack, but I'm going to be talking about it next week and address some of these things. But I hope this has been informative, and I'll see you then.